All right, here we are again. So we're going to pick it up where we left off the other day. This is our chapter 11 discussion. This is a very interesting chapter because it involves foreign exchange, which I don't know about you, but I think it's a very interesting topic. So far, what have we done? We've been able to go through our discussion about spot exchange rates. Let's go back to the beginning for a second. Spot exchange rates. The fact that the currency markets trade $5 trillion a day worth of currencies, that was quite interesting. We looked at foreign exchange quotes. We saw there's different ways of quoting them, the direct and the indirect way. For example, $1.4166 per pound is a direct quote because that is the dollar price of the pound in the United States, at least. And in the United States, the indirect term would be so many pounds per dollar. In this case, 0.7059 pounds per dollar. Obviously, they both mean the same thing, but you can see that sometimes certain currencies like the dollar and the pound tend to be quoted as dollars per pound. The same thing is true with dollars per euro, whereas others like the yen tend to be quoted as so many yen per dollar. But still, we can do either way. We can use direct terms and we can use indirect terms. Now, we went through and saw some current quotes on the Wall Street Journal. You can see, obviously, there's a very large number of currencies trading out there, and then these are all the different exchange rates between them. And we noted that there's a few cases where the dollar's not mentioned at all, and we saw that these are known as cross-exchange rates. All right, and of course, as it turns out, though, even though the dollar is not explicitly mentioned, they're actually derived from dollar exchange rates anyway, because the dollar is considered to be the world's vehicle currency, or the most important currency against which all other exchange rates are quoted. Okay, and then we looked at the distinction between spot and forward transactions. The spot transactions were the ones where we bought a currency for current delivery, or sold for that matter. And then a forward transaction is one where the delivery of the currency will not take place until sometime in the future, typically 30 to 90 days, or although it could go out more than that. A currency swap is a combination of both a spot and a forward transaction, where a currency is bought or sold today with an agreement to undo that transaction in the future. So if, for example, we agree to buy pounds today, we may also simultaneously agree to sell pounds in the future at a price that's determined in the contract. We call this a currency swap. All right, and so we also took a look at this chart where we saw the different kinds of transactions that take place every day in the foreign exchange markets, and we saw that the total, and this is only going back to 2013, I'm sure it's gone up since then, is more than $5.3 trillion every single day. All right, that's a lot of trading. And we'll see later on some of the reasons for that, but we say that the majority of them are swaps. We have a lot of spot transactions. We have less forward transactions. And then options, which we'll be getting to today, as a matter of fact, are also a popular choice for trading foreign exchange. We also noted that foreign exchange prices are actually listed as two numbers. We have a low price and a high price. We call them the bid price. This is our bid price over here. This is the ask price over here. And you can tell which is which because as the buyer of currencies or the seller, we always find ourselves at a disadvantage compared to the foreign exchange dealer. For example, in this case, if I'm, let's say, a consumer and I need pounds, I'll pay the higher price to the dealer. And when I come back from England with my pounds, I can sell them back to the dealer, but I'm going to sell them at the lower price. So the difference between these two numbers is called the bid-ask spread, and that's the source of the foreign exchange dealer's profits. Okay, this is how they make their money, by charging a higher price when they sell and paying a lower price when they buy. Every transaction puts money in their pockets. And this is how it's done in a dealer market like foreign exchange. Okay, now we also discussed the economic impact of changes in exchange rates. We saw that when a currency is strengthening, it is said to be appreciating. When it weakens, it is said to be depreciating. And what we noted is that a stronger currency, let's jump ahead a little bit here, means that we're going to have a worse trade balance because our exports have become more expensive to foreigners, whereas our imports from abroad have become cheaper. So an appreciating or strengthening currency sounds like a good thing, but it is not helpful to our trade balance because it makes our products less competitive in foreign markets. And in the long run, a stronger currency will lower inflation, which is good, but it could potentially increase our unemployment rate as we are able to sell fewer and fewer goods to foreign countries. Now, we also saw that we had some numerical examples to explain this. So we can jump ahead over these for now, since we've already seen them. The depreciating currency does the opposite. It means our products are cheaper in foreign countries, so we will export more. And it also means that our imported products are more expensive, so Americans will buy fewer foreign goods. And the combination of these two means that our trade balance is improving. All right, but then in the long run, the problem with that, though, is that yes, our trade balance is improving, which is potentially lowering our unemployment rate. The problem, though, is that prices can go up as a result, and therefore we can have higher inflation. So whether a currency appreciates or depreciates, there's always a benefit and there's always a cost. All right, so now where did we leave off? Oh, we started talking about forward and futures markets. There are four basic types of derivative securities through which we can buy and sell foreign currencies. Now, these contracts are mainly designed to help us hedge foreign exchange risk. Okay, now, if you're doing business overseas, for example, you might find yourself needing to buy products or buy resources using foreign currencies. You also may find that your revenues are denominated in a foreign currency, and that introduces a lot of risk because you don't know what the exchange rate will be in the future. So these four types of products, which are all collectively known as derivative securities, were designed to help eliminate foreign exchange risk. Although, as we also saw, they can also be used for speculation on the future direction of foreign currencies. The forward contract, we started to look at this. It is an agreement to either buy or sell an asset at a specified date in the future at a price that's agreed on today. And that's the whole reason why we like these so much, because we can lock in a price at which we can either buy or sell a currency in the future without any transactions taking place today. All right, so in other words, if I know, for example, that I'll need to buy pounds in the future, I can enter into one of these contracts and lock in the price at which I'll be able to buy them today. In a way, it's like an insurance policy. It prevents the price from going up in the future, although at the same time, it also prevents me from saving money if the price goes down. All right, now, here's a quick example that we looked at. We have a spot exchange rate of 169.80 per pound, and we can also take 6-month delivery of pounds for 1.6715. So the one we will choose will depend on what we need to do with those pounds. If, for example, we need the pounds now, we will, of course, buy them in the spot market and pay $1.69.80. If we won't be needing them until 6 months from now, you could still buy them in the spot market today, but that will tie up your funds for 6 months. It also would be more expensive in this particular case. Why not just enter into a forward contract in which we agree to buy the pounds in 6 months and pay for them in 6 months? Okay, this not only locks in our price, but it means it avoids tying up our funds for 6 months. All right, so that's one of the reasons why these contracts are so popular. It locks in the price, and it means we don't tie up our funds buying currencies that we won't need for 6 months. Now, we saw that in this particular example, the importer needs to buy 10,000 pounds in 6 months. So he could, like I said, buy them now, but that means he's got to set aside $16,980, which isn't doing a whole lot of good, although in principle, he could invest that in or put it in the bank for 6 months. But still, that's a lot of money to be sitting around idle when it could be used for something else. And also, we may not have the money today. That's another thing too. What if we don't have the money to buy the pounds today? Having a contract to buy them in 6 months gives us 6 months to raise the money we need to buy the pounds. So there's a bunch of different reasons why a forward contract can be extremely convenient in reducing risk. Now, on the other hand, yes, if they decide to wait 6 months to buy the pound, though, the price could go up. All right, so we don't want that either. For example, if at the current spot exchange rate of 169.80, we would have to pay $16,980 to buy our pounds. If we wait 6 months and hope for the best, look what happens if the dollar gets weaker. It depreciated to $1.75 per pound. And all of a sudden, those same pounds will cost us not $16,980, but $17,500. Now, that might not sound like a big difference, but that might mean the difference between whatever we're trying to buy being profitable and not being profitable. Because if we're in business, we may have very low profit margins, which could be swallowed up by foreign exchange losses. All right. So what do we do? Oh, but of course, if we wait 6 months, we know that there's a chance that the pound could get weaker or the dollar could get stronger. And then we might be able to save a little money. Like, let's say if the exchange rate drops to $1.60, well, then we'd be happy because we're actually getting them for $16,000 instead of $16,980, which is nice. But you know what? The reality is, let's say this is a manufacturing company and they make their money by selling appliances in Europe, let's say. They're not in the business of speculating on foreign exchange. Okay, to them, it's just gambling. So while, yes, there's a possibility that by waiting we could save some money, the company may not think that it's worth the risk and say, listen, we don't want to do that. Let's go ahead and enter into a forward contract. That way we know what we're paying in 6 months and we don't have to worry about it. And we don't need to tie up our funds for 6 months. So therefore, we enter into the contract to buy pounds in 6 months at the 6-month forward exchange rate, which we saw was quoted at $1.67.15 per pound. So therefore, we not only get to pay a slightly lower price than buying them in the spot market, but we don't need to actually pay for them for 6 months. Now, here, one thing about forward contracts, which we'll see later on too, is that once you enter into this contract, though, you're pretty much committed to buying those pounds. Let's say something changes and you would prefer not to buy the pounds. You might be able to convince the other counterparty to this contract to cancel the contract, but you shouldn't count on it either because it is a legally binding agreement. So once you're in, you're basically committed to buying those pounds in 6 months. All right. Now, if we're looking at the perspective of an exporter who needs to sell pounds in 6 months, they would just basically do the opposite. Instead of entering into a contract to buy the pounds, they would enter into a contract to sell the pounds because they will have pounds to sell in 6 months and they know roughly how many, and they'd like to lock in the price at which they can do so. All right. So, and by the way, if you're the buyer in one of these contracts, you're said to have a long forward position. And if you're the seller, you're said to have a short forward position. That's just terminology. You don't need to memorize that, but this is how these positions are often referred to. Long typically refers to somebody who's buying, and short typically refers to somebody who's selling. All right. Now, how would you turn around though? Let's say you're not involved in the foreign exchange markets at all. You're not exporting goods, you're not importing goods, but you are an investor who thinks that you understand how the foreign exchange markets work and you want to gamble. You want to roll the dice. You want to take a position that will pay off big time if you're right, although you could lose a lot of money if you're wrong. How could you speculate on the future direction of foreign currencies through a forward contract if you chose to do so? Well, let's take a look at the same example. We have these, the spot exchange rate is 169.80, And the forward exchange rate for 6 months delivery is 1.6715. Now, here we have somebody who thinks that in 6 months, the dollar will get weaker, by which we mean the price will go up. It will take more dollars to buy a pound in 6 months than it does today. This is his view. And suppose he really, he's pretty sure this is going to happen. He has reason to believe that the dollar will in fact get weaker. And he's decided, I'm going to gamble on this. I'm going to put myself in a position where I'll make money if this actually happens. Well, how would he do that? Well, he would enter into the contract and agree to buy the 10,000 pounds at the 6-month forward exchange rate, which means that he's agreeing to buy 10,000 pounds in 6 months for a total value of $16,715. Now, what happens in 6 months? What if he's right? The dollar depreciates up to $1.70. And that's only a small change. What he has the right to do now is use his contract to buy the pounds for $16,715, and he can immediately sell them in the market for $1.70 each, which adds up to $17,000. So he's able to buy something for $16,715 and then resell it immediately for $17,000. And so he's just made himself $285. Now that doesn't sound like a lot, but he didn't put up any of his own money or take any risks. Well, not really. And if he's a bigger gambler, he can just enter into a contract to buy 100,000 pounds or 1,000,000 pounds. There's no limit to what he can do, as long as he can find somebody else to enter into that contract with him. Now, the problem, though, is that, of course, what if it goes down to $1.60? Ooh. In fact, let me throw that in here as a supplement to this example. Suppose instead that in 6 months, the dollar appreciates to $1.60 per pound. Now that hurts because he's obligated to buy those pounds for the price he agreed to, which is $16,715. And he doesn't need the pounds either. So in other words, he, rather than hanging on to all these pounds, you'll have to sell them for a loss. He'll pay $16,715 for them and sell them in the market for, $1.60. And that means he has a loss of, 16,000 minus 16,715. Wow. That's not good. Okay. In other words, he ends up losing $715 because the dollar got stronger. But that's what speculating is all about. It's gambling. If you're wrong, you lose money. If you're right, you make money. That's how it works. But a lot of traders in these markets are, in fact, speculators. It's not just hedgers. It's also speculators. And so that's why the markets are so big, why there's so many currencies being traded on a daily basis. Because we have hedgers and speculators trying to either reduce their risk or else increase their risk with an eye towards making a profit. And you notice that in this case, at least, no foreign goods or services were bought with these pounds. This was just pure speculation. All right, now if this speculator was expecting the exchange rate to go up, and so he entered into a long forward contract. If he felt the opposite, if he really believed that the dollar would get stronger, then the smart move would have been to enter into a contract to sell them. In other words, enter into a short position in pounds. Okay, so a short position would be entered into by a speculator who's expecting the exchange rate to fall. In other words, it's stronger dollar. because if he's right, he'll make money. All right, so here we go. Just to recap all of this, a market participant may enter into a long forward contract to buy a currency for two reasons. One, to hedge the risk of a rising exchange rate. And number two, speculate that the exchange rate will rise in the future. In the first case, he saves money. In the second case, he makes money from his gamble. But on the other hand, why would you enter into a short position? Obviously, for the opposite reasons. You would enter into a short position to sell the currency if you are worried about the price falling, or if you believe that the price will fall and therefore you want to speculate on the price dropping. And that means you would make money if you're right. Okay, now, here's one thing we want to consider today. This is something new. When we had these examples going on here, we saw that the spot exchange rate was quoted at 169.80 per pound, and the forward exchange rate in 6 months is quoted as 167.15. The question is, why are these numbers different? Why aren't they the same? What is it that's driving this relationship between the spot exchange rate and the forward exchange rate? Well, we've got a formula for you, and you'll see that this is driven by time and the interest rates in the two countries. And that's all there is to it. All right, let's jump ahead here now, and let's take a look at this formula. Now, this is a general formula. This is not just for currencies. In general, we can calculate a forward price from the following formula. Okay, so what exactly do these terms mean? All right, let me give you a minute to write this down. This is a very important formula. You can see there's a strict mathematical relationship that holds between the spot exchange rate and the forward exchange rate. All right, so let's see how this works. First, F is the forward price, as you can imagine. S is the spot price. Risk-free rate here is R. Now, what do we mean by a risk-free rate? That's actually an important detail. Let me do a little side note here. A risk-free rate is the yield on a security in which the investor is guaranteed to receive the cash flows that have been promised in a timely manner. What do I specifically mean by this? This means that all treasury securities are considered to be risk-free. Okay, so now that requires another little detour. You may be aware that the US government borrows a lot of money, a lot of money. How do they do that? They don't go to a bank, for God's sake. What they do is they sell securities known as treasury securities. A treasury security is a type of bond which is sold to investors in exchange for the investor money. The treasury agrees to pay the investor interest payments every year until the maturity date of the bond, at which time the money paid for the bond is refunded to the investor. Let me show you a quick example of this so it'll be less cryptic than this. So let's say, just to keep it super simple, for example, oops. Yeah, let me just let you catch up for a minute. Let's just say that we decide to buy in fact, you know what, why don't we go look at a website for a second before we even do that. What this is the Treasury Department's website. And so all of the securities that they sell, all the treasuries are listed here. And you see that they have a large number of maturities available to us. So what this means is, let's say you choose a 2-year bond or security. This means that if I buy this, I'll be receiving interest payments for 2 years. And then at the end of those 2 years, I'll get my money back. You can see that we could have everything from 1 month all the way up to 30 years and everything in between. And so the interest payments are listed here. So for example, if you bought a 30-year Treasury bond, as it's called, this represents a 2.23% interest rate, which you'll be paid every year for 30 years. And then when the 30 years are up, that's when you get your money back. Now, usually the amount of money that you have to pay for these securities is $1,000. If not, now it used to be much higher. What they've done recently is they've tried to make it a lot easier for investors to buy these securities, mainly because they're desperate for the money. But for some of these, you can actually buy as little as $100 at a time. And in fact, you can actually buy them directly through the internet without having to go to Washington or go to a broker. And so they're trying to make it easier for you to buy these, because when you buy these securities, you're basically lending money to the government to cover their deficits. So they want you to lend them that money. And so that's why they'll make it as convenient as they can for you, the investor. All right. They want your money. Let's put it that way. But the thing is that's important here is that the reason why we're even discussing this is because the government is in a unique position. If they say to you, I'm going to give you 2.23% per year for the next 30 years, you can count on it, because unlike a private corporation, which can go out of business, the government can't go out of business. And if they run out of money, they can raise taxes or sell some of their many, many assets. The government owns a lot of assets as well. And so you can be quite confident that they will make those payments when they're supposed to be made. Because if they don't, what will happen is people won't trust them, and they'll have to pay a lot more interest to borrow your money. So they're going to move heaven and earth to get that money to you if they have to, because they know what it would do to their borrowing costs if they do not make their payments on time. So any one of these securities could be defined as a risk-free security, and these could be defined as risk-free rates. All right, so now, for example, if I'm looking at a 6-month forward exchange rate, one part of that formula will require the US risk-free rate for 6 months, which is currently 0.07%. It's essentially zero. It's really close. It's not exactly zero, but it's really, really close. In fact, you have to get it out past 5 years just to get over 1% from these things. They're so low. All right. Anyway, in our formula then, we have that risk-free rate of interest, which means the yield on a treasury security. The time here tells us how long it takes until the forward asset is delivered. Now, this Q is the yield of the asset itself. Now, when we're dealing with currencies, this actually turns out to be the risk-free rate in the foreign country. Now, every country has a government that borrows money like crazy. There's no such thing that I know of as a government out there that has surpluses, or at least I'd have to do some checking. All of Western Europe, even Japan, well, Japan, Canada, all of those governments have a lot of debt. And the way they pay for it is to issue securities like this. And so the returns or yields on those securities are what we mean by risk-free rates of interest. In other words, the returns to government securities. And every country's returns are different. They can be very different, as a matter of fact. Ooh, let's see, hold on. Germany, oh, all right, I'll tell you, I'm going to say maybe to that. They have trade surpluses. I'm not so sure. Let's find out. In a positive, oh, let's see. Here it is. Well, what do you know? Somehow they managed to get themselves a little surplus going on here. I don't know how they pulled it off. Oh, no, that's projected. Oh, they're just guessing. See, oh, but they were ahead. Yeah, you're right. I don't know how they managed to do that. Wow. And these guys, they must have rock solid discipline. I mean, really. So you were right. Germany does have a small surplus.
Yeah, I remember hearing that. I don't remember where I heard it from.
Wow. And these are deficits because of COVID, obviously. But, well, I'm impressed. Let me tell you, I can hardly imagine any other country in the world like France. Let's see what theirs looks like. Oh, yeah, that's more like it. Yeah. How about, well, let's even Japan. You would think Japan, the country where everybody saves. No, the government spends like crazy in Japan. That's their debt. Okay, I wanted to see their budget. Oh, well. Let's see if I can find it.
Singapore might have a surplus.
Oh, maybe. No, that's not what I wanted. I don't know. All right, maybe I'll just go to over here. Okay, yeah, they did have one until, of course, the COVID came along. That's interesting. Wow, look at that. Okay, well, let's look at ours. Good God, where do you see this? What happened? It seems to have ignored. I don't know.
Maybe just try like U.S. budget balance.
I don't know what I did wrong. That's what the others did. I mean, that's how I found the other countries. Let me change it to United States. Wow, I don't understand how it can be so different from one country. Let's do it up here. You know what, who would have this? Fred would have this. All right, here we go. Dun, 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 dun. So for the longest time, there was more or less imbalance, and then it started to come down, and it briefly went up again, and wow. Now, some of this is COVID, of course. A lot of it is, but still, you get the idea that since the 80s, more or less, the normal experience has been, with a couple of exceptions, or this one exception, all deficits. And so because of those deficits, they have to borrow the money to pay for those. They can't just say, well, I'll pay you when we get around to it. They have to pay for what they buy, just like everyone else. But they can borrow the money from the public by issuing these treasury securities. But market participants, not just in the United States, but throughout the rest of the world, are confident that if they buy one of these securities, they will get the money they've been promised. And so that's why these rates can be so low, because their credit is essentially perfect. And they know that, and they'll never do anything to jeopardize that. So in our formula, then, we're going to need the yields on these US securities whose maturity matches up with the contract. So for a 6-month forward contract, you would be using this number as one of the inputs into the formula. And then let's say it's the dollar and the pound. You could go to England and find their equivalent curve for their government securities. In fact, maybe we can find them. UK Treasury yields. I'm sure if we were willing to spend enough time to look for it, we could get it. See, this one says world government bonds. So, well, I was hoping to get a chart. Oh, here it is. Their yield for 6 months is 0.018%, whereas ours was 0.007, wasn't it? Something like that. So their yields are very low too. First, partially because they're government securities, but also because they're very safe. Now, what's interesting is you notice in England, not in the US, our treasury securities only go out 30 years. They have 40 and 50-year bonds as well. Man, that's a long time to save your money, 50 years. But they have them if you want one. So if we were looking at the dollar and the pound exchange rate in this formula, the yield of the spot asset means the risk-free rate, let's say for 6 months, would be 0.018%. And so that, along with the maturity of this contract, would tell us what is the proper forward exchange rate between the dollar and the pound. So let's see if we have an example here. All right, so here I just made up a bunch of numbers. Let's say that the spot exchange rate between the dollar and the pound is $1.80 per pound, and the 3-month US rate of interest is 2%. Just to make it, a nice round number, 2%. The UK 3-month rate is 4%. So we could plug these into our formula and come up with the implied 3-month forward exchange rate in the following way. By the way, this E is something you may have run into in, let's say, if you've ever had any exposure to calculus. E is approximately equal to 2.71828. So you're raising, in this example, this is, all of this reduces to 0.02 minus 0.04 times 0.25, that's negative 0.005. So what you're actually doing here is 180 times e to the minus 0.005, which you can do on your calculator. Any decent calculator will have a key on it labeled e to the x. And so this reduces this is my forward exchange rate. This is the 3-month forward exchange rate, which means if I want to buy pounds for delivery in 3 months, I would expect to pay $1.79.1 each. Now, the way this works is that if the US rate is higher than the UK rate, then F will be greater than S. In other words, the forward exchange rate will be higher than the spot exchange rate. But in this case, it was the other way around. if the US rate was less, if US rates are lower, that means it's cheaper to buy pounds in the future than it is today. Now, the reasoning behind this is actually quite involved. I don't know if we have time to get too deeply involved with this. Maybe later on we'll come back to it. But the actual logic behind this relationship is fairly complicated. Essentially, what it comes down to is, you in principle could borrow in one country and convert it into another currency and lend it out in that second country. The forward contracts or the forward exchange rate really tells us what exchange rate would equalize the returns to investing in both countries. I mean, that's really what it is. But anyway, so this is how these forward exchange rates are determined in the market. It's not, there's a very, very specific, as you can see, mathematical relationship that has to hold between the two. All right, well, anyway, now how about hedging? Let me just show you a diagram here, how you can hedge with foreign exchange forward contracts. I mean, we've already discussed it, but I wanted to show you this specific example because it involves kind of an interesting chart. So what happens here is that we're going to show two cases side by side, one in which we hedge our risk and one in which we don't. Okay, so let's take a quick look at this. So we're using forward contracts to hopefully eliminate our foreign exchange risk by locking in the price at which we can buy them or sell them now, of course. So let's just say in our example, an importer in the US needs to buy 100,000 pounds worth of British goods in 6 months. And as we've already seen, if you wait 6 months, the dollar could get weaker and we'd have to pay more to buy these pounds. Exactly what we want to avoid. Okay, it's like anything else. If you wait and you have to pay more, that's going to be a problem. So what do we do about it? Well, we happen to be very savvy about derivative securities, and we decide, why don't we enter into a forward contract and eliminate our foreign exchange risk? How cool would that be? All right, well, let's find out how cool that turns out to be. Oops, let me get this out of here. What if we enter into a forward contract and we lock in a price of $1.70 per pound? All right, 6 months from now, I can buy my pounds, my 100,000 pounds, for $170,000. I've got no foreign exchange risk. If the exchange rate goes up further, I won't have to pay any more for them. But if it goes down, I can't save any money. All right. Now, let's look at this diagram. Here I've got the price of 100,000. This is the exchange rate, or I'm sorry, this is the dollar price of buying those pounds. And let's say here, 160,000 would be the cost if the exchange rate in 6 months is $1.60. If in 6 months the exchange rate is $1.70, I will at that time pay 170,000. And if the exchange rate in 6 months is $1.80 per pound, I will pay 180,000. So this line is what will happen if I do not hedge my risk. This is I call it my unhedged position. So therefore, if the exchange rate goes up, I have to pay more. If it goes down, I get to pay less. It's the hedge position that I'm interested in, though, because I'm locking in a price of $1.70. So no matter what happens here to the spot exchange rate, I'm set. This is how much I'm paying. Now, what should I do? Well, that depends. I mean, if you just want to get rid of all of your risk, then you certainly should hedge your position. On the other hand, if you're kind of nervous, but you're pretty sure that the dollar, if anything, will get stronger and will be down here somewhere, maybe you're willing to take a chance and wait and see what happens. On the other hand, if you think up here will happen, if the dollar is going to get weaker, then you absolutely want to hedge your position. So the two lines represent, in a very compact way, I must say, the difference between hedging your position and not hedging your position. So it's a gamble any way you look at it, but a lot of market participants are not interested in gambling. They just want to lock in a price and be done with it. And those are the hedgers. Then, of course, there's the others who want to gamble, and they will certainly not hedge their position. All right. Anyway, now, in addition to forward contracts, we also have something called futures contracts, which basically are very similar to forward contracts, but they have a few very important differences. They are designed, like the forward contracts, to help us eliminate foreign exchange risk. Now, where do you get these? One of the important differences between the two is that a forward contract is an agreement between two what we call counterparties. Usually, if you're going to enter into one of these contracts, you're going to enter into it with probably an investment bank because they have the expertise to be involved in this market, and they have the technological knowledge and all this and that. So let's say I'm a small company and I'm doing business in Japan. I might get a hold of, let's say, Goldman Sachs and say, listen, I need to enter into a contract to buy yen in the future. And then we agree to a price, and that's the end of it. A futures contract trades on an exchange, not the New York Stock Exchange, but on specialized derivatives exchanges, of which one of the best known ones, let me show you this real fast, is the Chicago Mercantile Exchange. Let me just quickly jump over there. And you'll see on here, they have everything. Okay, this is one of the top derivatives exchanges in the world. And they have everything under the sun. Now, look at this chart. They're telling you that the average daily notional value, that's the value underlying the contracts, for all foreign exchange derivatives, $78.7 billion a day. Now, that doesn't sound like much. Let's look at some of these other ones. With equity indexes, it's over 700 billion. With interest rates, the amount underlying these contracts is over $6 trillion every single day. So people who buy these contracts are either speculating on foreign exchange risk or they are hedging it. So they offer all these contracts that you could potentially choose from. And let's take a look at a couple in particular. Let's see if we can find some quotes for foreign exchange futures. Let's see. Okay, I'm looking at British pound futures contracts. So this is the volume of trading, but I really wanted to look at the price quotes. Well, I was hoping that these would be the quotes. I do want to point out a couple of details. A single contract gives you the right to buy or sell 62,500 pounds. And they trade through this exchange. And this is the current quote. This is the last price they have, $1.38.90 per pound for future delivery of the pound. Now, what's unusual about these contracts, though, is that unlike forward contracts, there's only a handful available. So like, look at this one, this chart. If I decide to enter into a contract to buy British pounds, let's say in May, the price that I'll pay when in May is 140.10. And let's see, the volume was only seven contracts have traded today. Most of the trading is in this contract, which is expiring at the end of this month, 95,000 contracts. But this contract is set up so that I can hedge my risk in British pounds. The price that I'm locking in is 138.89 per pound. Okay. Now, by the way, I want to mention one other important thing here. This is because it's an exchange. They make their money from volume. They want people to go crazy buying all these products. So because of that, under the category education, they have all this wonderful information for people who want to learn more about these markets. And it's all free. Okay, you can actually download these courses and watch them at your leisure. Let's see. So you look for something you're interested in and you launch the course, just watch it for free. They're not going to charge you. Why? Because they're hoping that you'll buy their products if you understand more about them. There we go, Introduction to Foreign Exchange. And they have this whole course you can watch. I'm sure it's a video. And we're not going to do it now, but I mean, if you wanted to, in fact, I'll tell you what, let me send you this link in case you decide that you want to watch it. All right, hold on one second. But it's completely free. And who knows, maybe you might end up working in this area and when you're done with college. Who knows? All right, hold on one second. All right, there it is if anybody's interested. And you might, if you explore through here, you might find that they have other stuff you might be interested in. And yeah, you never know what you might learn from these. And so again, this is completely free because again, they're hoping that you'll become a future customer. Even whether for yourself or whether the company that you end up working for. So don't overlook this. So remember, it's CME for Chicago Mercantile Exchange. And because it's an exchange, they have lots of educational material available for free. And that's because, of course, they want to attract you as a customer. All right. So anyway, so this is where they trade. Futures contracts trade on an exchange, whereas these forward contracts are negotiated directly between counterparties. Okay, so that means, like I said, if I need a forward contract, I have to get a hold of an investment bank or if, some other foreign exchange dealer and negotiate the terms of my contract. The futures contracts, you just go to the exchange and buy one. Now, is that good or bad? Well, I'll tell you what. Here's one of the good things about this. If you buy a forward contract from, let's say, a Goldman Sachs, the problem is that they can go out of business and you're left sitting there with a contract with nobody else to live up to their side of the contract. So there's always some risk here that the other side of the contract either will disappear or else they will simply not have enough money to live up to their obligations. So there's always what we call default risk. Default means you do not live up to the terms of a loan or other contract. All right. So default usually refers to debt. Okay. So let's say I'm in a contract to buy 100,000 pounds from Goldman Sachs. Well, if they're out of business, there's nobody there to sell me those pounds. And so there's a risk there. With a futures contract, the performance is guaranteed by the exchange. So you have nothing to worry about. If there's a problem, they will cover everything. It will take care of it for you. That's kind of a big deal. Now, another thing that I want to point out, though, and I guess I'll add this to, Let me just add one more slide in here because I think this needs to be included here. Since forward contracts are negotiated between counterparties, they can be customized by the two counterparties. In other words, if you need something unusual, all right, let's put it this way, they can be customized to the needs of the counterparties. For example, the contract can specify the delivery of any currency, delivery on any date, and the quantity of the currency, etc. So in other words, you can just negotiate directly with each other about what you want in this contract to say. With the futures contracts that we were just looking at, there's nothing customizable about it. With futures contracts are what we call standardized, which means that the investor can only choose from what's available at the exchange. Okay, so in other words, you saw that list we were looking at before. I had the option of buying, oh God, where did it go? I must have, oh no, you know why? Oh, I see what happened. Here it is, it's back. No, that's not it. I know what happened because I was showing you this link. There's only certain months available for delivery with these contracts. And also, for example, a British pound futures contract traded on the CME, Chicago Mercantile Exchange, is for 62,500 pounds and can only be delivered in March, June, September, or December. So if you're fine with that, that's great. But if you need something else, this is not for you. Because let's say you need a very obscure currency that's not available at the CME, or you only need, let's say, 2,000 pounds and you need delivery in October. Well, that's not going to work for you. So you'd have to go back to a forward contract. But if you do need what they have, that really works very well. So these futures contracts are standardized, which simply means you have to take what they have. There is no other option. With a forward contract, you can have whatever the counterparty will agree with. All right, so that's a huge deal, but that's because of the way they're traded. Again, because the forward contract is negotiated with the counterparty, you can set it up any way you like. If you go to the exchange for the futures contract, you basically just have to take what they have. All right, now the other thing too, though, and this is interesting, with a forward contract, like I said before, it is a binding legal obligation. Once you enter into it, you're pretty much committed to buying or selling the currency. A futures contract, though, it's easy to get out of it because what you can do is take a position in the opposite contract. Okay, so for example, what do I mean by that? A March British pound futures contract, a long position, I should say, in a March British pound futures contract can be offset with a short position in a March British pound futures contract. So you're not actually getting out of the contracts, but you're setting up two contracts whose cash flows exactly offset each other. Okay, so there's the cash flows to the two contracts exactly offset each other. That's the key to the whole thing. Right? That's why it amounts to the same thing. You're not actually getting out of those contracts, but you're setting up a position so that the two offset each other. All right. I guess it would be like if, let's say that you borrowed money from somebody, and rather than paying it back, you lend them money. It ends up meaning the same thing because you now have no position with that person. Now, because of this, what's interesting is that most people who buy futures contracts don't actually take delivery of the underlying currency. They offset it just before the delivery date, and so they collect their profits if there are any, and they don't normally actually buy or sell the currency. Whereas with forward contracts, almost invariably, the currencies do trade hands when the contract matures. So if you really don't want the currency, you just want to hedge your risk, you might be better off with a futures contract. But if you really need the currency, you could actually use either one, because you can still take delivery with the futures contract. But at least the futures contract, it's not necessary. All right, and then one final difference, where what happens here is that with the forward contract, you're just saying, listen, will you agree to do the following in the future? That's the end of it. Here, though, with a futures contract, you actually have to put up margin or collateral into an account when you get started. Yeah, and it's kind of a nuisance. All right, so you might be forced to put money into an account with the Chicago Mercantile Exchange, in which your money's sitting there and you can't really do anything with it. And to make things even worse, if your position starts to lose money, they'll take it out of your account. So we call this marking to market. And this is only going to happen on a futures contract, not a forward contract. This is with a futures contract. The value of your position is reevaluated every single day. And if things aren't going so well, they may ask you for even more money to be put into your account. And that could end up costing you a lot of money. All right, imagine yourself buying one of these contracts, and all of a sudden they're calling you up saying, you know, you've got to deposit another $1,000, or you've got to deposit another $3,000. So this is one of the real drawbacks to futures contracts. And so you have to put money into your account, which is called a margin account. And the money you put up initially is called initial margin. All right, initial margin. Now, let's go back to Chicago Mercantile Exchange. It probably mentioned how much margin there was for each contract. Let's take a look at the British pound contract. So here they're telling us that the contract is for 62,500 pounds. And let's see, where's the margin requirement? Well, that's odd that it doesn't even mention it. Wow, I'm surprised. I don't understand how they could put that there without the margin requirement. All right, I guess we're not going to find out. But it's not normally going to be a huge amount. Like here, for example, this is worth 62,500 pounds. Let's say they're selling for $1.40 each. that means the contract is written on $87,500 worth of pounds. The margin requirement might only be $2,000 or $3,000. It's a fairly small amount, but it's still kind of a nuisance, especially because if your position deteriorates, you could end up paying what's called variation margin, which means you're putting more money into this account. And if you can't come up with the money, they will actually close out your account. So that could be a real nuisance. All right, so here's a quick summary of the differences between the two, which I found in the book. It was very helpful of them. So with a forward contract, the issuer is probably a commercial or an investment bank. The futures contract is probably being traded on the Chicago Mercantile Exchange or one of the other ones throughout the world. With the forward contract, we're actually contacting the counterparty by phone and negotiating the terms, whereas the futures contracts are still being traded in the pits, they're called, on the Chicago Mercantile Exchange. The contract size is completely customized to the needs of the buyer or seller, whereas the futures contract is only certain quantities are available. The delivery date is negotiable with a forward contract, and the futures contract only specific dates. The contract costs, well, I mean, there's this bid-ask spread on the forward contract, of course, but there's no actual fees of any kind, whereas you do get that with the futures contract. And then finally, settlement, by which they mean, when do you pay for this? You pay for the delivery of your currencies when the contract expires. That's it. Whereas the futures contract, you might have to put money into your margin account every day if you lose money. So other than this, now these are important differences, but basically it's exactly the same logic for forwards and futures as to how do you hedge your foreign exchange risk. If you're buying in the future, you want to enter into a long contract or long position. If you're selling, you want to get into a short position. Because that way, when your spot position loses money, your contract will gain in value. Just like your insurance company only pays you when you've had an accident. So it's the same idea. It's a hedge. You're trying to make sure you have money coming in when things go wrong. Now down here, it looks like I did manage to get my hands on a price quote for the Chicago Mercantile Exchange. This is for Japanese yen, by the way. All right, so let's hold on a second. Let everyone catch up. All right, so let's look at this these quotes. All right, so here, I don't know where these came from, but they came out of the book, actually. They're giving you, these are just like stock quotes. The opening price, the high, the low during the day, the settlement price, which determines if you have to put more money in your margin account, the change from the day before, and how many contracts were traded, open interest. You can see the open interest falls off very sharply as we look further into the future. Also, this contract is for 12.5 million yen, where the prices are quoted as so many dollars per 100 yen. All right, now that's that. So because this discussion centers around hedging, what we're going to do now is look at, finally, the mysterious foreign exchange options, which we mentioned a ways back when we looked at that chart to show where all the trading is coming from. Okay, so let's scroll back up for a second, and you'll see that way at the bottom here, we have foreign exchange options. which clearly are not quite as popular as the others, but still they're very important because they're yet another way to hedge our foreign exchange risk. Okay, but there's some very important differences between them and these forward and futures contracts. All right, so let's go look at that. I've got this in a separate section, by the way. I called it part 2. Let's go get that open because it's a very long chapter. Let's get that open. So this is our introduction to options. Okay, it's not that long, but options are an incredibly important type of derivative security. What really separates out options from the others is that you have the right to do something, but never the obligation. Okay, in other words, you might have the right to buy British pounds in 6 months at $1.40 each, but you would never be required to do so. And so that's what you were required to do with a forward contract. You were required to do that with a futures contract, but you could offset the contract. But here, you have the right to say, no, I don't want to buy that security because I've changed my mind. Market conditions have changed. So the name option is very well chosen because it means you have the option or the right to buy or sell the underlying asset. Now, we can look, I don't know if, I know where to find stock option prices. I have to look around and see if I can find currency option prices. Ooh, the markets are tumbling. But anyway, so if we look at a stock like, let's say, Apple, we can actually go find option prices for Apple. And the chart, yeah, here's the charts. So when we're done analyzing all these different features of options, we'll come back here and we'll see what these numbers are actually trying to tell us. Right now, it won't mean anything to you, but when we're done, all these numbers will tell you exactly what you want to know about these options. So we need to be able to characterize an option in several key ways. First of all, what exactly is it giving you the right to buy or sell? So in this case I just showed you, clearly that something is Apple stock. But options are available for all kinds of assets. It's not just stocks. Okay, in fact, some of the things that you can buy with options might really surprise you. Like what? All right, let's take a quick look. Options can be bought in many assets like interest rates, for example. Well, there's currencies, of course, equities, which are stocks, equity indexes. Those are indexes like the Dow Jones and the Standard & Poor's 500. We also have precious metals like gold, silver, platinum, palladium, all the rest of them. And here's an interesting one: futures contracts. You can actually buy an option that gives you the right to enter into a futures contract. And those types of options are known as futures options. All right, futures options. Yes, that's what they're called. You have the right to enter into a futures contract rather than buy these assets directly. So there's tons of things. Now, in addition to these, you can now buy options on non-economic variables. For example, you can actually buy options on the weather. You can buy an option, for example, where you get paid if there's more than a certain amount of snowfall or rainfall. That kind of thing is also available. There's all kinds of crazy options out there, but most of them focus on these financial assets. All right. Now, the price at which you're allowed to buy or sell the underlying asset is known either as the strike price or the exercise price. I don't know the origin of these names, by the way, but yes, either strike or exercise price, that's the price at which you're allowed to buy or sell something in the future, if you choose to do so, of course. All right, what else do we need to know to characterize an option? How about the maturity? The option expires at a certain time in the future. And that could be anywhere from tomorrow to 6 months or even a year from now. After that, it is worthless. Okay. What else do we know about options? Well, I did say before that they give you the right to either buy. Oh, here we go. Okay, sure. Anyway, the maturity. Oh, okay. So the next thing I did say earlier that the option gives you the right to either buy or sell an asset in the future. Now, no option gives you the right to do both. It has to be one or the other. So it turns out that the option that gives you the right to buy something is known as a call option. And the option that gives you the right to sell something is called a put option. Now, again, I do not know the origin of these names, but this is what they're called in Wall Street. And so just remember, call means buy, put means sell. Okay, now there's one other classification that we need to know about. And that, all right, well, give you a minute to catch up. There's one other way in which they can be different from each other. And that refers to the privileges that you have with this option. Let me show you what I mean by that. The two basic types of options are called European and American. The European style options can only be exercised on the expiration date. Okay, so for, let's say, European call option on Apple, you could buy the Apple stock, but only on the expiration date of the option. The American style can be exercised any time until the option matures or expires. Okay, so those are the two basic, there's others, there's plenty of others, but those are the standard ones. The vast majority of options in the market fall into one of these two categories. All right, now here's one important thing that's different about options. Besides the fact you have the right to do something but not the obligation, another incredibly important difference between options and, let's say, forwards and futures is this. With an option, you have to pay for it. Okay, so remember, a forward contract is just an agreement. There's no money changing hands until you buy the asset. A futures contract, you may have to put money in a margin account, but that's still your money. You're not actually paying for the privilege of entering into this contract. An option is different. You must pay for an option because it is so valuable. And we call that price the option premium. Now, this is where the rocket science gets involved. If you've heard about this at all, the math gets very heavy when we try to figure out how to price these options. That's where all the high-end math comes in. We're not going to be doing that right here. What we want to understand, though, is that these prices reflect the right to buy something without the obligation. So if I want to buy an option, unlike a forward contract, I have to buy it and I have to pay a price to the counterparty. So an option in a lot of ways is like a forward contract where you can change your mind. And the ability to change your mind is what we're paying for here. That's why we have to pay for these, because it's such a valuable right to give to somebody. Now, there's a long, interesting history about option premiums and the attempts to capture them with a mathematical model, which we'll maybe go over some other time, but just be aware that in order to buy an option, you have to be prepared to pay for it. And that's because they're so powerful. And another interesting thing about options is when you own an option, unlike most securities, there's a limit to how much you might lose, but there's no limit to how much you could make. And that sounds pretty exciting, doesn't it? Limited loss potential combined with unlimited profit potential. How could you go wrong? Well, you can. I mean, because obviously, there's no guarantee that you'll make any money. But what it means is that the upside potential is much higher than the downside potential. That's a nice position to be in. A very nice position. And, oh, all right. So we're not going to do that right now. Let's jump back to that page with Apple. So now this will start to make some sense. So here's the call for app. These are actually, oh my God, these are due tomorrow. Tomorrow's the last day that you can make up your mind to whether to use your option to buy Apple stock or not. Now, these are the calls, and down here, these are the puts are way down here. And what you'll notice is that they all have the same maturity date or expiration date. If you want to look at the others, they're in this list here. Now, we see the strike prices here. That means if I own this option, I could pay $70 to buy a share of Apple stock. Not bad, considering that the stock is worth almost $120. There's a bunch of prices here. The actual price that we will pay for this option is right here. In this case, it's $49.85. And so we also have the volume of trading. That means today. We have open interest, which is how many contracts are outstanding. And so each of these options has the same information. And so you notice the strikes range from 70 all the way up to 205. That's a lot of choices. And then down here with the puts, where we have the strike, and we have these are the prices. The ask is the one that we pay, and we have open interests, and how many contracts were traded that day. And wow, there's a lot. This is an unusual stock. It's very rare that any stock has so many strike prices to choose from, but this is one of them. Anyway, so what's going to come next is we're going to get into some of the more technical details of these options. And then at some point, we're going to look at how we could use them to hedge foreign exchange risk, because after all, that's why we're interested in here. So, but for now, since it's getting a little late, maybe we could stop right about here. I don't want to start a complex topic like right now. So instead, we'll cut it off right here, and then we'll pick it up again on next Monday. How does that sound? All right.
It sounds good.
All right, good. So see you all next Monday then.
Have a great weekend.
All right, you too.
Have a good weekend.
Have a nice weekend, Professor.
Bye. Okay, so any questions? All right. Oh, do you want to ask something? Oh, you're walking outside, I see.
Oh yeah. I thought that class is still going on. Yeah. So I have a question about like homework because I know that you assigned homework in the beginning of the semester, and I find homework to be useful.
Oh, those homers are just for practice. They don't count. You're not going to hand them in. We're just going to go over them and practice with them so that you can get ready for the exams.
That's fine. But like, what I'm asking is like, could you possibly assign more assignments?
All right. Sure. Absolutely.
Yeah. And my my second question is what is the midterm going to be like? Both
Oh,
of the
when
midterms going
yeah,
to be
it'll
like?
be just like, it'll be a lot like the practice problems.
Okay.
So yeah, so don't worry. We'll be going over the practice problems. We'll have a sample midterm, which is another opportunity to see what you're to expect. It'll be very much like the problem sets in the sample midterm.
All right. Great. And the final is going to be just like a longer version of that, or is there going to be like a
Now
writing?
the final will just be on the last few chapters that we cover. It won't be comprehensive.
Okay. All right. Yeah. Because I found like I find that like this is a lot of
It is a
information
lot
to
of material, but don't
digest.
worry. When you see the problem sets, you'll be very happy to see that they make sense and that well, you'll see. Don't worry. When we start going over problem sets, you'll be very relieved to see that they're very straightforward. Okay. All right.